Hi, I'm with Richard Vague, author of the book, The Next Economic Disaster. Richard, thanks for joining us.
Thanks for having me.
Richard, I'm interested in why you wrote this book and what the financial crises of 2008 and 2009 mean for the policy choices the nation needs to make and what this means for American society going forward.
Well, it turns out that this financial crisis and most major financial crises relate to rapidly growing private debt. And if that's the case, that means that future crises are preventable, which is extremely important, I think, in managing our economy. Furthermore, it means that we can go in and look at the excessive private debt that's been created and find ways to repair it, which will re-energize the economy.
You just focus on private debt, whereas most pundits, economic analysts, the debates that we have out in society focus on government debt, public debt. Why are you so focused on private debt?
Well, this is an important question. People do focus on government debt, but if you look at all the financial crises that have occurred in the U.S. and across the world, government debt is never the issue in major economies. In fact, government debt, we find, actually is improving and at worst benign in the period immediately before an economic crisis. So we think the focus on government debt is the wrong focus.
When you say that government debt is usually not the problem, the fact is when a crisis happens, a government responds trying to buffer the losers, government debt skyrockets, and then you do have a government debt problem. So what's wrong with that equation?
If the government relies on its own debt to solve the problem, it does help. It is a palliative. However, you end up with higher and higher ratio of government debt to GDP, which really is in effect using your dry powder and makes the government in a less flexible position in the future. So finding other ways to address the crisis, I think, is an important part of what we need to be thinking about.
What caused the financial crisis of 2008, and why did so many economists across the board miss forecasting it?
It was private debt that caused the crisis of 2008. It was primarily mortgage lending. Mortgage loans grew from $5 trillion to $10 trillion in a little over 5 years. It was an astonishing increase. And it was way too many mortgages. Many of those mortgages ended up being bad debt. And when they turned to bad debt, it caused financial crisis at the lending institutions.
Before the financial crisis of 2008, 2009, when the real estate bubble was so obvious, wasn't it the responsibility of people like Alan Greenspan, then chairman of the Fed, and other Fed governors to blow the whistle on that and to pop that bubble and be the corrective in that equation?
Well, it's interesting. And now here's where I think we come to the crux of the matter. You asked earlier why economists didn't catch this or predict it in advance. Mainstream orthodox economic thinking really omits or assigns to a tertiary role any consideration of private debt. That's a huge omission in my mind. It's not something that orthodox economists genuinely focus on. If you look at that number and you see it rising rapidly, you know a crisis is imminent. It's not a number people were looking at.
Richard, you're known as one of the kings of the credit card business, the founding CEO of First USA Bank. You built the affinity card business that all of us get points for credit cards. And so you've benefited a lot from the growth of private sector debt in the U.S. economy. What red flags have gone up that have made you so worried about the state of private sector debt in America today?
Well, I think that private debt, if it's at a low level in an economy, is a very good thing and can drive economic growth. However, when private debt reaches levels that are too high, that's when the problems begin to occur. In the U.S. in 1950, private debt to GDP was 56%. Today it's 156%. It's tripled in 2 generations. So it's not private debt per se that's the issue. It's when it grows too rapidly and then when it reaches levels that are too high.
In pointing to other crises, economists sometimes point to trade deficits, current account imbalances, short-term money flows to explain other crises like what happened in Asia in 1998 or in Japan in 2001. What are, according to your analyses, the reasons for that some of these other economic crises have occurred?
You know, we've looked comprehensively at this issue. We've looked at every major financial crisis in major economies post-World War II. That's, as many as 22 crises, depending on how you count them. In essentially all of those crises, private debt was the issue. And in fact, the opposite is true as well. Anytime you have a rapid growth in private debt, 20% to GDP in 5 years, frankly, is our benchmark. Anytime you have that happen, you have a crisis. Conversely, anytime you see a crisis, you find that there was rapid debt before that. So it really boils down to that one issue. And people have speculated on a lot of other things, as you mentioned, like current account deficits, government debt, and so many other things. We've looked systematically at this, and there's no other factor that comes close to being as predictive and is as much of an issue as private debt. Our focus really needs to be on private debt.
What are 2 or 3 of the most important indicators that tell you that an economy is barreling towards a crisis? What pops up? What are the red flags that you see?
Well, the 2 that we look at the most are the growth in private debt. If in a period of 5 years you have a 20% or more growth in private debt to GDP, that's the first factor. The second is that your overall level of private debt is high. And we use roughly 150% aggregate private debt to GDP as that benchmark. Once you have a combination of those 2 things, you're highly likely to have a financial crisis.
Tell me where China is today in both of those figures.
China's figures are alarming. China's growth in private debt to GDP in the last 5 years is over 50%. The numbers are a little fuzzy. You get slightly different numbers from slightly different sources. It's at least 40%. It's probably over 50%. And aggregate private debt to GDP is at least 180%. So China is at that point where a crisis is likely, and unless they take the appropriate steps, we're going to have an issue.
Why does too much private debt cause a financial crisis?
Well, when you have too much financial private debt, it means you're building too much of something, that you're creating overcapacity. In the '08 crisis, we built way too many houses. We built, 4, 5, 6 year supply of houses, far beyond what we needed. In other crises, such as the Japan crisis of '91, you were building too much commercial real estate. We can go back and find other situations, other crises where we built too much of something else. But when you've built too much of something, 2 things happen. One of them is you've created a lot of bad debt. And normally you've created more bad debt than there is capital in the system. In the '08 crisis, we probably created on the order of $2.5 trillion worth of bad debt. The banking system only has about $1.5 trillion worth of capital. Clearly you had a problem of major proportions. So the one thing is you've created a lot of bad debt, and you're going to have to recapitalize the lending institutions. But the other thing is you've created way too much capacity of some critical thing like housing, and no monetary or fiscal policy can shorten the amount of time it takes you to absorb that capacity. If you have 5 years of excess capacity in housing, it's going to take you several years to absorb that. And economic growth is going to be a lot lower in the period while you're absorbing that capacity.
When the real estate bubble was building, why do you think regulators, economists, financiers just turned a blind eye to what was an obviously growing bubble?
Anytime you have a rapid lending situation, it looks like good news while it's happening. The banks are making a lot of money. Consumers are getting a lot of things. Everybody feels like they're winning during a boom, including the government, whose tax revenues increase. So that's the kind of environment where self-rationalization occurs. People repeated endlessly during that period that real estate values had never fallen. Well, of course they'd fallen, and in many markets, in many places. They just hadn't fallen in the last couple of decades in the U.S. But that was the kind of mantra people created and trotted out because there was so much good news, or it felt so good.
Can we predict financial crises?
We believe that we can do a reasonably good job of predicting when a financial crisis is likely. And I mean with like 80 to 90% certainty, if we look at the 2 factors, 20% growth in private debt to GDP in 5 years, an absolute private debt level of 150%. It's not perfect, but it is indicative, and it's something folks should take very, very seriously.
When you see the signs of a financial crisis coming, what steps can be taken to prevent it?
Well, regulators have a lot of latitude to come in and use, I was a banker for decades, I know what regulators can do. They can come in and influence credit policy. They can influence capital requirements. They can do a lot of things. The Federal Reserve, through its interest rate policy, can break or curb the direction of lending. So there is a complete arsenal the regulatory apparatus can use to influence these things, not the least of which is just discussing the issue. I think it's fully within the purview of regulators, if they focus on this variable, to do things to prevent crises in the future.
In your book, do you provide any kind of playbook for policymakers, maybe 1 or 2 or 10 steps that they can take to sort of slowly let the air out of a balloon so that it doesn't explode on the back of the middle class?
Well, you need to think about this 2 ways. One of them is, can we prevent it? And we've just discussed that. But the second is, once one has already occurred, what should we do? And keeping lending institutions alive in lending to healthy borrowers is certainly a big part of it. And we focused on that properly in this last crisis. Providing capital and liquidity support to banks is what does that. By the way, it doesn't mean that you have to keep the management and directors of those institutions intact. It just means that you need to keep the operations of that institution intact. But the other thing that has been a neglected tool here is restructuring problem debt. Consumers today still, after all these years in the U.S., but more importantly in Europe, are carrying way too much debt. And if they are having to make payments on debt, that means they're not spending it on goods and services. And frankly, that dampens economic growth. Going in where you have underwater mortgages, problem debt, and restructuring it will free borrowers up to spend on goods and services and reinvigorate the economy. After you've preserved the lending institutions, done all those things to avoid a complete meltdown, you're left with too much debt. A tool that has been neglected is going in and restructuring debt. We think this should be done to free up borrowers who are now spending too much to service that debt, free them up to use that money, if you will, on goods and services and reinvigorate economic growth. There's a lot of ways to go about it. We've proposed one, which is allowing institutions to spread the pain of that restructuring over an extended period. We propose 30 years. But these programs need to be there, and they're not today, to any great extent.
What inhibits the private market from just doing what private markets do, moving in, sort of identifying bad debt, syndicating it, rolling it up, selling it off, marking it to value, and then just moving on? What is keeping the private market from just working as it normally has in the past?
You ask, why does the private sector not just take care of this problem? And the issue is the sheer magnitude of the issue. As I mentioned before, we probably had $2.5+ trillion in problem debt created in a system that only had about $1.5 trillion of capital. It's too much for the system to rectify in a short period of time. The private sector does take care of it, absolutely, but it takes a generation or two. And the place where we see that most evidently is in Japan. They had their crisis in 91, 23, 24 years later. Their economic growth is still going sideways. They still have too much debt in the system. That is the central factor. It just takes too long.
We've heard a lot about household mortgages being a primary driver of the last financial crisis. Is it your view that this is mainly a consumer debt problem that led to those crises?
Folks have focused on the fact that this was consumer debt in the '08 crisis. But we need to consider that it could be business debt as well. In fact, business debt was a small part of the issue in '08, but business debt was the culprit in the '91 Japan crisis. It was the culprit in the '97 crisis in Asia, primarily Korea and Indonesia and Thailand. It was the issue in a lot of the big crises in the 1800s, the canal crisis of 1837, the railroad crisis of 1873. So business debt can be the culprit too, and I think we have our blinders on if we just focus on the consumer side of the equation.
So in 2008, private sector debt to GDP in the United States was about 160%. What is it today?
Well, it was 56% private debt to GDP was 56% in 1950. It grew through this entire period, raced up in the 2000s to over 170%. It's now down to about 156%. So we have deleveraged a little bit, but we're still 15% higher than we were in 2000, 50% higher than we were in 1980.
Do you feel the U.S. economy is still at risk today because of the very high levels of aggregated private sector debt?
I don't think the U.S. economy is at risk for another financial crisis right now because private debt to GDP has been benign. It's been flat. It's been going sideways. However, it is at such a high level that it is a damper on economic growth. We can't have as robust growth as we would like and as we experienced in the 50s and 60s with private debt levels this high.
Economists have pointed to credit default swaps and debt securitization as two of the culprits that might have contributed to past financial crises. If we were to regulate these more, in your opinion, do you think they would help us prevent future financial crises?
Things like securitizations and credit default swaps played a big role in the '08 crisis, mainly because they allowed banks to, in essence, sidestep capital limitations. And so some folks have focused on those instruments and, in fact, have become quite expert in those instruments as a way to safeguard against future crises. But the truth is, banks have innovated ways around capital restrictions for 200 years. And it is not the type of instrument that is the issue. It's the aggregate amount of debt in any form that is what you need to track to prevent these crises. If you completely restrict securitizations and credit default swaps or things like them, banks will find other ways to minimize capital requirements and circumvent these requirements going forward. Looking at the aggregates is what tells you the story.
One of the features of our financial system today is that larger and larger institutions are making macro loans across huge portfolios and then syndicating those off and selling them off to others who may care less about those portfolios than the original loan maker made. Is that a problem in our financial equation?
It's clearly an issue. The fact that you can originate loans and someone else bears the risk, and therefore your rigorousness in making those credit assessments is not what it might be otherwise. But that's been a problem for 200 years. In the 1800s, we issued bonds, which are, in essence, have the same problem associated with them. I think the same was true in the 1920s. There are lots of ways to separate those who originate risk from those who bear that risk. I don't think it's possible to eliminate that in any system. It is, however, possible to monitor it, again, by monitoring the aggregates.
Richard, I know you've been looking at the debt pictures of a lot of countries, particularly using data sets for their debt behavior over the last century. Are there any nations that really jump out at you as ones that you're very concerned about?
Well, I think the real issue now is China. In the U.S. and in Europe, you reached really high debt levels, and those debt levels are high, but they aren't growing rapidly at this point in time. The same is true in Japan. They reached very high levels in '91. They've really been going down or sideways since then. The place where you've had extremely rapid growth in private debt is China. And as we mentioned, it's grown over 50% in the last 5 years and it has reached a level of over 180% to GDP. Our focus should be on issues that emanate from China.
If you could define for us a healthy economy, what would be the key features of that economy?
Well, I think the ideal, and this, if you reflect on it, this is somewhat intuitive. The ideal, if you want rapid growth, is a country that has a country or a continent or whatever, or a globe that has too little capacity and low private debt. That's really the situation we had in the U.S. In the immediate post-World War II period, where we were experiencing 3, 4, 5, 6% per annum GDP growth. Low capacity and low debt is ideal. The situation we have today is overcapacity, too many houses, and too much private debt. It's kind of the opposite of what you would want for robust financial growth. And that's not just true in the U.S., it's more true in Europe than in the U.S., and it has become true in China. China was in the opposite position maybe a generation ago, certainly 20 years ago, maybe even 10 years ago. They had relatively low private debt and were trying to build capacity. Today, they too are in this situation of having more capacity than they need. We read about ghost cities and far too much private debt. Really, the entire world is in this position today, which portends relatively slow financial growth going forward.
If you could wave a magic wand and fix the U.S. economy today, what would you fix? And if you could send policymakers any message and say to them, here's what you really need to focus on to get the economic vector of the country moving in the right course, what would those instructions be?
Well, I think the most useful thing you can do in the short term that is not currently being addressed in any aggressive way are these debt restructuring programs, particularly the underwater mortgage programs. We've had small efforts that haven't gone very far in those areas, but I would do something that was broad and addressed the problem comprehensively. I think we're doing a lot of other things right. That's the one thing that's really not being addressed at the level it needs to be.
Can you give us a snapshot of private sector debt today? What does it look like? How much is consumer loans? What is student loan debt? How much is household mortgages? What does that all look like? What are the different pieces to it?
$26 trillion in private debt in the U.S. And about 55 to 60% of that is business debt, and the rest is consumer debt. So let's say 11 or 12 trillion that's consumer debt. Most of that, about 70 to 75% of that consumer debt is mortgage debt. So the 800-pound gorilla on the consumer side is mortgage debt. Credit card debt is a small sliver. Even student debt is only about $1 trillion of that 10 or 11 trillion total. That's what we need to focus on there.
What do you think accounts for the reasons why economists and pundits and policy practitioners are so focused on government debt and that side of the equation and have a blind spot to looking at the much larger numbers that you've outlined in the private sector debt part of the economic equation of this country?
I think it's natural for folks to focus more on public debt. It feels more like we, the people's responsibility to focus on public debt, and certainly the purview of politicians. You know, in a free market economy, it feels like we ought to keep hands-off proposition relative to private debt. However, if private debt causes crises and all the attendant pain and years and decades of issues, that makes it public policy to focus on private debt.
In the 1950s, we had a situation in which there was both low capacity in the country and low private sector debt. And then as households leveraged up, the middle class in this country really erupted. It became very, very large. Today, the middle class feels like it's under siege and eroding. Is there a link between the state of the middle class today and our economy that's very, very different than what we saw in the 1950s?
Yeah, for a country or for the globe, the issue is the same. If you have low capacity and low private debt, and private debt, by the way, and the pain associated with it has fallen disproportionately on low to middle income consumers. But if you have low capacity and low private debt, that is an ideal environment for a growing middle class. You need a growing middle class to build that capacity, and private debt is a tool that gives them resources to do that. We kind of have the opposite situation today. If you have too much capacity and too much private debt, that's a recipe for middle class growth to either plateau or decline. We think that's central to understanding what's going on with the middle class today.
Why do you think private sector debt is the central factor in driving an economy?
Well, private debt's the central factor in driving the economy because it's the biggest factor. Right now, private debt is 26 trillion, government debt is 10 trillion. Less than that. The difference was even greater in the past. But it's important, in the period from 97 to 2007, private debt grew by 14 trillion. Public debt only grew by about 3.5 trillion. Private debt and lending, by the way, in essence creates new money in the economy. So $14 trillion in lending growth in a 10-year period was $14 trillion in money flooding the economy and creating all these good feelings that ultimately led to the problem. Private debt is the thing that correlates most closely to GDP growth itself. It's the 800-pound gorilla.
One of the things I find really interesting about this is whether the collective blind spot that we all have about the debt picture, the private sector debt picture, is that we've all been trained to sort of think that the market takes care of winners and losers. It slaughters losers, it rewards winners that make smart investment decisions. But now the government has moved in and saved banks that are too big to fail. And it raises the question of whether the private activity that we all thought was moving of its own natural laws is now the domain of taxpayers' concerns and taxpayer dollars. Has that really fundamentally changed the way we should think about all of these questions as we move forward?
Yeah, I think if you look over 200 years, and if you look at all developed economies, all the major economies of the world, it happens again and again and again, irrespective of government policy, irrespective of the monetary regime. What happens is lenders start lending too much. It happened in the 1830s, the 1870s, the 1890s, 1920s, obviously leading to the Great Depression. It happens again and again and again. That's what, that's what makes it worthy of our focus.
Richard, thanks so much for sharing with us your thoughts and the outline of your thinking with your book, The Next Economic Disaster.
Thanks for having me.